From the American College of Financial Services, welcome to Annuity Insights, in partnership with New York Life.
Welcome again to the Annuity Insights podcast at the American College. I'm Michael Finke, Professor of Wealth Management at the American College, and I'm here with Justin Bateman from New York Life. Justin is the Corporate Vice President of Retail Annuities. And Justin, today we're going to talk about annuity myths. And I'm going to cheat a little bit because I'm actually going to focus on quotes from Dave Ramsey. I'll probably include a Suze Orman quote in here as well. But what's interesting is that when someone doesn't know anything about annuities and an advisor recommends an annuity as maybe part of a accumulation strategy or a retirement income strategy, they go online and they look at what the experts have to say about annuities, and they get a lot of negative information. I have criticized Ken Fisher in my own articles for the trade press, where I've said, basically annuities are just a tool. They are a financial product structure, just like ETFs, just like mutual funds. There's appropriate ones and inappropriate ones, but criticizing an entire product structure when there are obvious benefits to those products, there's a whole field of economics on the annuity puzzle, because so many economists think that annuities are, in fact, it's been proven mathematically, they are the most efficient way to generate retirement income. And so many so-called experts criticize them, despite the fact that real academic experts believe that annuities should be an essential part of a retirement income plan. So that's been one of my quests in the past, is helping advisors understand and also helping consumers understand when annuities can be beneficial. But let's take this opportunity to talk about what the experts, the so-called consumer experts, say about annuities. What are the criticisms? And then by doing so, I think we can help advisors, when they get some of these criticisms, be able to provide an objective response to consumers who may be concerned about the advisor who has recommended an annuity as part of their retirement income plan. So let's start with Dave Ramsey. One of the most popular sources of financial information in this country is Dave Ramsey, and he thinks that annuities are, quote, super complicated. Are annuities super complicated?
Yeah, Michael, and first off, thanks for having me. Happy to be here. Yeah, so, when I looked at that quote, I took a step back and, I realized the source where it was coming from. And when you look at annuities at a high level, the complicated part, I just don't think that's completely accurate at all. There's a great suite of annuities out there in the industry today that are, essentially very easy to understand. Very little bells and whistles, right? If we look at the fixed deferred annuity part of the industry, many of them have return of premium on day one, right? Clients can get their money back, no questions asked. As we know, they're an guaranteed interest type product, and it's straight to the point. You invest in the with the insurance company for, say, 3 years, you earn a set guaranteed interest rate, and after those 3 years, you're free to go.
Yeah, and even when it comes to income, there's a wide range of different products that provide lifetime income.
Yeah, and looking at that quote again, I still feel many folks in the media, and I'm sure you agree, when they're talking about income annuities, they're talking about income annuities from, say, 20, 30 years ago. Today's income annuities are vastly different. There's that, I guess, theme out there from some of the folks who aren't that familiar with income annuities, that you're giving your money up to the insurance company and you're never seeing it again, which is completely false. One of the more popular options out there is what's known as life with cash refund. The individual gives a premium to the insurance company and they get paid income. And if they haven't received their premium back in income, their beneficiaries are made whole. So someone's being made whole when it comes to an income annuity, and it's very easy to understand, one of the most elected type of features out there. So the old saying of, if you give your money to an insurance company for a lifetime income annuity, it's gone forever, is just simply not true in this day and age.
You mentioned the fixed deferred annuity, which is essentially it operates like a CD. You put the money in and then you get the money out. It's not FDIC protected. Usually the yields are a little bit higher, but it's super straightforward. I mean, it's money in, money out. And then there's income annuities. So you can start with things like a single premium immediate annuity, a SPIA, or a deferred income annuity, a DIA. You provide a lump sum of money and you get a promise of lifetime income. That's not complicated. And there are plenty of other financial products that exist within this ecosystem that are way more complicated outside of the annuity sphere. Annuities can be as simple or as complicated as you want them to be. And I say that because I think a lot of times the complexity occurs because of consumer demand. So you mentioned a return of premium option. Well, that makes this be a little bit more complicated, but it's one of the things that people demand in order to trade a lump sum of money for a lifetime income. They want to know that they at least get their money back. And when you think about some of the bells and whistles on annuity products, they exist because consumers want them. Now, but Justin, do you think sometimes products get unnecessarily complex in the annuity space?
Yeah, in some areas I do, Michael. I think, when some carriers are trying to maybe one-up each other and they're trying to add more and more bells and whistles to the equation, it can just get a little bit complex. I think that's where, from a provider of annuities, you maybe take a step back and are all these, bells and whistles, necessary, right? You look at some of these more complex products, they have proprietary indices that they rely on, and that makes it a little bit more confusing for the client. Where do I go and seek my returns? How can I look up potentially with the index I'm leaning on a daily basis? Where does that live? And so I do agree with your first point, right? The annuities have evolved based on customer feedback and demand, and in a way that is very beneficial for the client and the retiree. But what I don't like is when annuity providers then perhaps go and take it upon themselves and create some of these features where they think the client might understand and benefit, and then what happens is the client's eyes just start glazing over when you're explaining all the different features. And so it's a delicate balance, when it comes to the evolution and current product features that are being offered out there.
Yeah, and I think the bottom line for advisors is that these relatively straightforward products are pretty easy to compare in terms of, what is the guaranteed rate of return, what is the amount of income that I can generate per dollar invested. That's the kind of product that tends to see a lot of intense price competition among providers. Oftentimes, these products that are highly differentiated based on some of these complex characteristics, it can be a little bit difficult for an advisor or a consumer to understand what they're getting and whether or not they're getting a fair deal for what they're investing in. So I get the criticism. I think that there is an issue within the industry of excessive product differentiation and excessive complexity, and oftentimes consumers can end up getting something that doesn't really match what they wanted. So something for advisors to be aware of is that very often, the more complex something is, it's either because it's what consumers really want, or it's a way of differentiating the product, but also making it a little bit difficult to price compare. So let's also talk about whether annuities are, quote, this is a Dave Ramsey quote, bogged down by a lot of fees that cut into the return on your investment and keep your money tied up. Is that true? Are annuities very expensive?
Where the fees do present themselves, obviously, are the variable annuities, but those fees, they come with features and benefits, in my opinion at least, that perhaps a really expensive, say, mutual fund just does not offer, right? A lot of what's built into those fees, and when you look at fees, in the variable annuity space, over the last half dozen years, they've come down substantially. So I think that's one thing advisors should, obviously keep in mind. But, right, a lot of the aspect of the fee is a guaranteed death benefit. If in the VA space, if a client puts in $500,000, unfortunately, if they pass away, they're at $250,000. Part of that fee, the beneficiary gets the full $500,000 when they walk away. So there's a mortality component to the variable annuity that just isn't present in other type of investments, right? It's for some folks, if they can't qualify for life insurance, or they might just have too much on their plate when it comes to life insurance policies, a VA is a very nice way to allocate yourself and know that your bennies are at least getting what you put in with a return of premium VA. But again, that's where the fee aspect comes from. And when looking at alt investments in today's universe, VA fees really aren't that much higher, if higher, than some of these alt type of investments, right? You look at certain mutual funds out there, and the fees are, north of 130, 1.3%. So I think when it comes to fees and variable annuities, you're paying for a benefit that you just can't get from other investments. And if you did want to try and couple something with alt investments and add on some sort of death benefit, you're going to be paying anyways, perhaps in the form of a premium with life insurance. So the fees themselves, while I love how outsiders comment on fees, they've come way down in the VA space over the last 6 to 10 years. And when you look at alt investments today, when you peel back the curtain, those fees are just as high, if not sometimes higher, than a traditional variable annuity fee.
Yeah, I think one way for an advisor who is trying to wrap their head around how expensive annuities are is to, first of all, think about what the average longevity of their client is. A good rough estimate of average expected longevity for a 65-year-old healthy person that's likely to be a client of a financial planner. Remember, they live a lot longer than the average American, is about 88 for a man. It's about 90 for a woman. And if you want to estimate on average how much money you're going to get back from the lifetime income component of an annuity, just to estimate, if you had invested in bonds all the way to the age of 88 or to the age of 90, net of fees, then how much would it cost? And then what you'll see is that the insurance premium is probably pretty close to that amount if it's priced fairly. And what we've seen from the research is actually they're almost too attractive, price attractive. In essence, even if you just live to your average longevity, you're probably going to do better than if you'd invested in especially a treasury bond portfolio, because the insurance company, they seem to be baking in a certain amount of what we call a credit risk premium. So you're going to be getting your money back as if you would have invested in treasuries to the average longevity. Plus, you're going to get a little bit extra. Plus, you get lifetime income protection. So that's why annuities really dominate bonds as part of a retirement portfolio, is that you're going to get about the same expected income to the average longevity. But if you live longer, then you're going to continue to get that income. And that's why economists see annuities as it's a puzzle that people would invest in bonds and not annuities in retirement, because they really dominate. Now, when you talk about things like lifetime income benefits on a variable annuity, or let's say a fixed annuity, or even a RILA with a lifetime income benefit, those benefits they cost money to the insurance company. So a good way to think about it is that it's not really a fee, it's an insurance premium that protects you against the possibility that you're going to outlive your savings. So the insurance company collects those premiums, they invest it in the general account, and then for those retirees who live a long time, they pull the money out of the general account and they continue to provide them with a lifetime income. So I think fees is kind of a misnomer when it comes to many annuity products, especially for a lifetime income benefit. They're not really fees in the sense that they're comparable to, say, asset management fees. They're more like an insurance premium, where the insurance company expects to return a percentage of those premium payments to the people who buy the annuity in the form of a lifetime income guarantee. So, are they laden with fees? There's obviously a range of different types of annuity products, a lot of spread products that don't have an explicit fee, where they're very price competitive. If an advisor were trying to create the same thing on their own, they would have a very difficult time, especially after AUM fees.
As the baby boomer retirement wave crests, it's time to position yourself as the ideal partner for this growing pool of clients with the American College of Financial Services Retirement Income Certified Professional designation. As an RICP, you'll get the specialized knowledge to help more clients with complex retirement planning needs. With the convenience and flexibility of the latest in e-learning design, the RICP delivers applied knowledge from over 45 retirement experts on Social Security, taxation, income planning, Medicare and Medicaid, long-term care planning, and more. Get started in our 3-course program today and become an RICP in 12 months or less. Now is the time to strengthen your client relationships with deep expertise to address the unique challenges of retirement. See how you can expand your opportunities at theamericancollege.edu/RICP.
If you are enjoying this content, please check out the New York Life Annuities Education Center. Designed to support you in growing your annuity business, with the tools, insights, and resources you need. Visit the Advisor Education Center at NewYorkLifeAnnuities.com.
So let's talk about another quote. When it comes to a fixed annuity, there are no benefits. Just don't. There's never, ever a case where fixed annuities are the best option. Zilch, zero, big goose egg. Is that true? Is it never the right choice to buy a fixed annuity?
Yeah, no, I don't think that's true at all. Again, when you look at the source, there's a few different some big benefits from when investing in a fixed deferred annuity. Obviously, guaranteed rate of return, often, as you mentioned earlier, right, Michael, in this much higher than any CD alternative that you can get on the street. Yeah, there's money market funds out there, but guess what? Those have some sort of fee, though it's minuscule. There's fees attached that can potentially eat into the return, but fixed deferred annuities, as I mentioned, attractive rates of return, return a premium, that feature where if you want your money back, no questions asked, just write a letter into the insurance company, you get that back. And then there's a huge, a few different components as well, right? Once you earn all that interest within a fixed deferred annuity, the IRS doesn't force you out of that fixed deferred annuity. You could move those funds via 1035 exchange, right, which is a non-qualified fixed deferred annuity moving tax-free into a new fixed deferred annuity, or roll it over and keep deferring those gains. With other investments out there, you're paying taxes on a yearly basis, which really eats into the return. Fixed deferred annuities, you're getting that compounded growth year over year, and if you continue to move into different types of annuities, right, if we focus on the fixed deferred annuities, that growth just follows the transfer into a new annuity, and there's no taxation there. And then when it comes to, even looking at the legacy part of it, Michael, annuities as a whole, but if we look at, again, fixed deferred annuities, if the individual were to pass away, a big component on fixed deferred annuities is, they bypass probate. So if that beneficiary thinks their money is getting tied up, a feature with fixed deferred annuities is bypassing probate from a legacy standpoint. Often beneficiaries, have their proceeds in their hands within 3 to 5 days, right? And so, a lot of beneficiaries might not understand, how it works from a legacy standpoint. And so, though it's not a huge feature, that we promote, some of those, little features really make the client feel comfortable when explaining the benefits of a fixed deferred annuity.
I think a lot of times when people criticize annuities, and I've seen Susie Orman doing the same type of criticism, which is, they're comparing a product which is created from bonds. So the general account portfolio of an insurance company is a regulated portfolio. It has to consist of relatively stable investments like bonds, and when you're investing in bonds, you can either do it yourself or you can do it through an insurance company using an annuity. And if you compare apples to apples, which is bond investments on your own, which are annually taxable through the annuity product, you can get that tax deferral benefit. And many, especially if you continue to defer those gains from taxation, that can really add up in terms of compounding benefits. So, the more gains are embedded in the annuity, the more money you have to compound over time. And that really can dominate traditional types of annually taxable investments, such as traditional bond investments or CDs or money markets, things like that. It can be a much better place to put your money for long-term growth when you consider the performance net of taxes. So I'm not really sure where Dave's coming from, but I think possibly one of the things that he's suggesting is that when you put the money in bonds, you're going to get on average a lower rate of return historically. Dave is famous for saying that if you just invest in good mutual funds, then you should be able to get 12% return on average per year, which is actually not true. He doesn't understand these concepts. It's the fact that the actual growth on equities is probably 2 to 3% less because of geometric returns, because equities are volatile. And so, when you compare something that has this risk premium to something that doesn't have the risk premium, then it's an unequal comparison. You really have to think of those types of very simple annuities as bond-like assets. And I'm sure I've said something that's going to get me in trouble with compliance when I try to make comparisons of annuities with investments. But the reality is that when you're thinking about where to put your money, putting your money in annuities allows you to get those tax-deferred gains. All right, let's move to the next quote. Apparently, quote, there are some benefits to having a variable annuity, and in parentheses, though they don't outweigh the cons, are there any benefits to a variable annuity?
Yeah, no, I think I hit on a few. Absolutely, there are. I hit on a few of them earlier in this discussion. One of them that's hard to beat really is when you look at the return of premium death benefit. No matter how far your account value goes down due to market performance, the beneficiaries are getting the original investment back, and that's part of the annual fee structure with the VA. You mentioned bonds, right? I think everyone remembers a couple years back that stocks and bonds didn't act inverse. They acted the same when it came to volatility. And in instances like that, if the individual is really counting on some of this money for legacy, you look at the guaranteed death benefit. And then when you look at the fee structure of a variable annuity, what's often hard to beat is when you come to the M&E fee structure. There's fee structures out there, right, that do not charge for growth. It stays flat based on your original premium invested, no matter how high your account value goes. If your original premium was $1 million and the fee was, say, 1.3, and that premium goes up to $2 million, you're still only getting charged the annual fee off of the original $1 million and the 1.3. So you have that, and then as you mentioned earlier in the call, the ability to either move tax-free into a different type of annuity strategy or turn that accumulation value into lifetime income, not for only one individual, but two individuals, which I think a lot of advisors sometimes, forget that the conversation usually involves two individuals. And as you know, usually one in the household is responsible for the finances, one isn't. And when that planning takes place and you're really setting these clients up for protection down the road, not just on one life, but two lives, all because of the benefits of a variable annuity. That's where when you look at the fee compared to other investments, the benefits that a VA can offer, really stand out, at least in my opinion.
All right, and I'm going to end on this last question because I think this is one of the most common misconceptions about annuities that I see, and even among advisors. It's a really surprising one to me. Do insurance companies win if you die early?
Yeah, so that's a conversation that, being just in the role I am here, that I have often. That type of quote, I think I mentioned it earlier, that is a quote from, that was maybe relevant 20, 30 years ago. The answer is no, the insurance company doesn't win. As I mentioned earlier, with income annuities particularly, right, because that's an irrevocable contract. You're giving your money up in return for an attractive income stream, again, over one or two lives, which is a super important part of planning. There's features within, income annuities where if you don't get your premium back in the form of income, your beneficiaries are getting at least what you put in. So simple example, individual puts in $500,000, they've received $200,000 in income, and they pass away. But remember, they invested $500,000. The beneficiaries will get a check for $300,000 to make sure that someone was made whole. So when it comes to the insurance company winning, it's just an old school way and a not relevant way of thinking about it in this day and age. Income annuities and annuities as a whole have really evolved so much over time since some of those, older school quotes. So the theme of insurance companies winning, it just doesn't ring true, at least in my opinion, anymore.
I think we can even talk about the kind of annuities that people are thinking of when they think about insurance companies winning if you die early. So let's say that it is you buy a single premium immediate annuity. It is a pure income play. There's no return of premium option, or you don't select the return of premium option. Even in that case, they're priced based on the average expected longevity of a retiree. And if you think about how long retirees are going to live, there's going to be kind of a bell curve distribution. And it is the bell curve distribution that allows you to pay as if you're going to live to the average expected longevity and get that higher income. Because if you do it on your own, then you're going to have to think about, all right, what if I live to somewhere on the right-hand tail of that distribution? So do I need to spread my money out so that I have a 20% chance of running out, or maybe a 5% chance of running out? So by handing the money over to the insurance company, you become part of this long life income club with other people who buy the annuity. And because you're part of the club, everybody gets to spend more money. But part of the deal is that if you're part of the club and you don't live as long, then you haven't got that income for as many years. However, from your perspective, you got to spend more money every year because you didn't spread the money out to the age of 95 or to the age of 100 to make sure that you didn't run out. Every year you got to spend more money and you didn't have to worry about running out of money. So, if you live to the age of 80, and you retired at the age of 65, your internal rate of return on the annuity was not as high as someone who lived to the age of 95, but you got to spend more money every year that you were alive in retirement, and you didn't have to worry about running out of money. And the fact that you perhaps didn't get as high of an internal rate of return doesn't really matter to you because you're dead. So, if you really think about the way economists think about an annuity, it's unambiguously better, even if you don't live as long, because every year that you were alive, you got to spend more money. And the point you made is that you can actually add different riders if for clients who have fears of what happens if I get hit by a bus a year after buying the annuity. Well, then your beneficiaries essentially can get your premium. It's no big deal. So I think that's a way to get people to feel more comfortable about it. But from the perspective of an economist, that doesn't bother me. I'm planning on buying an annuity at retirement to cover my basic expenses. To me, it's kind of a no-brainer, and I am going to seriously consider not getting one of those riders to maximize the amount of money that I can get in the form of income, because economists, we're a little bit more Vulcan than the average. We're a little bit more geeky, I guess, when it comes to thinking about some of these trade-offs. I'm maximizing the amount of income I get if I die when I'm 80. At least sad for other people, but every year I got to spend more money and worry less. Justin, thanks so much for joining us today to talk about some of these annuity myths.
Thank you for having me. Yeah, it's been a great conversation. I think we debunked, some, if not all, but it's been a great conversation. So thanks for having me.
And thank you, everyone, for joining us for another episode of the Annuity Insights podcast. Join us again for more important conversations about annuities.
Thanks for listening, and we hope you join us on future episodes. Annuity Insights is a production of the American College of Financial Services. Annuity Insights is produced and owned by the American College of Financial Services with generous support from New York Life Insurance Company. Accuracy of information is subject to change, taxes, legal, rates, etc., but believed accurate as of the time of recording, January through April 2025.